The Trade is brought to you by Vantage Markets, delivering one of Australia's most trusted and award-winning trading experiences. Explore smart trading at vantagemarkets.com.au.
Hello and welcome to The Trade. Well, before we take a look at the charts, let's take a look at the news that traders are watching. And Donald Trump has threatened to cut off government contracts with billionaire Elon Musk companies, while Musk has suggested that the president should be impeached, turning their bromance into an all-out brawl on social media. This comes in the wake of Donald Trump and Chinese leader Xi Jinping confronting weeks of brewing trade tensions and a battle over critical minerals in a rare leader-to-leader call that left key issues to talk further on the matter. And Broadcom has forecast third quarter revenue above Wall Street estimates, betting on strong demand for its networking and custom AI computing chips. Let's now turn to the charts and to get some technical analysis. Ilya Spivak joining us again from Tasty Live. Ilya, welcome. Good to catch up with you. Let's then first begin with, what we're seeing, I guess, more broadly with the US economy at the moment. This is all being overshadowed by that spat between Donald Trump and Elon Musk. Nonetheless, we have had some weak data this week. What are we seeing?
Very good to be with you, Andrew. And of course, everybody's got their popcorn out and they're watching the soap opera unfold. But we do have some real things happening here. Not surprisingly, the focus is on the state of the U.S. economy. You'd be forgiven for missing it. But the U.S. stock market, after, of course, a very blistering response following those lows in the wake of Liberation Day in early April, has stalled here. Just underneath that 6,000 mark. And very telling where that stalling happens. It starts about 2 weeks ago as the markets really start to grapple with the idea that the tone of the economic data has darkened. And we saw it this week most potently with that service sector ISM report that gave us a shock decline in what is easily the most significant, most influential sector responsible for U.S. growth. And so we see this stalling and the market's kind of grappling with the idea of what comes next. The sentiment story obviously positive, but now we have to reckon with what the business cycle is actually doing, and that's going to put the spotlight on this U.S. jobs data that's coming at us in just a matter of hours, really. The expectation is that we're going to get a little bit of a slowdown, but not a catastrophic one. 130K on the menu, jobless rate seen holding at 4.2%. Of course, the interesting thing here, and this is where I suppose the Musk-Trump spat actually factors into a cohesive economic narrative, the markets want the Fed to come and do something. The break-even rates in bond markets are pointing to inflation falling. So while the Fed is sitting on its hands concerned which way to go on rates, is it an inflationary concern or an employment concern they need to have, the markets have seemingly spoken, and they want the Fed to come and start cutting. So if we get a really disappointing jobs number, the markets might actually read that as good news because the Fed would get off the sidelines. Obviously, the fiscal authorities are preoccupied with other things, as we learn here today. But if the Fed can get in here and do some cutting, I think the markets would appreciate it. If the surprise is on the upside, of course, that would suggest the economy is doing okay and cuts aren't necessary. That too might be encouraging. But the bulk of the distribution here, the most likely outcome is something give or take close to expectations, a middling result. And that would, of course, be the worst of all possible worlds because it would mean the economy is slowly grinding down as the Fed fiddles. And this, of course, would suggest that we might come off this 6,000 level lower and start to revisit some levels well below where we are now.
Now, earlier, of course, the president wants the Fed to cut. He's been leaning on Jerome Powell. As you mentioned there, investors clearly looking to further rate cuts to come later in the year. What are treasuries, particularly at the longer end, telling us?
Well, the very interesting story here is coming at us from the long end of the yield curve. The 30-year bond very curiously bottoms there at levels that initially set us a low at the beginning of the year, right there above the 110 mark, right as stocks hit the top of that range that we just looked at in the S&P. Stocks stop rallying at the same time that bonds come off that low and start to break their way higher. And what this is telling us is that the markets anticipate that the Fed is going to be slow to move on cuts. And so they're pushing the cuts deeper toward the back end of the yield curve. But then, of course, if the Fed is going to be late, if it's going to, as it were, demand to see the whites of recession's eyes before it moves, then you have more rate cuts that you probably have to do because you have to catch up to an economy that's already slowing. And so that seems to be what's going on. The markets have anchored their expectations for rates this year at about 50 basis points in cuts. But as the data grows more severe, even as the Fed is uncertain, they're pushing more cuts into next year. And again, if we get a kind of middling result on this jobs data, more of the same is probably on the menu. Weaker stocks and higher bonds, in particular at the long end, as the same dynamic holds. The economy is slowly withering by 1,000 cuts, and the Fed is waiting. Meanwhile, the fiscal authorities are preoccupied with this messy Trump-Musk divorce and this big, beautiful bill that they can't seem to pass. So the markets are getting no help. And that, of course, means you'll need more rate cuts even as they come later.
Now, earlier, of course, this notion that American exceptionalism is over has seen a sell-off in the US dollar. The question is what comes next, particularly, I guess, as we pair it with the euro, with the central bank there having just cut again, although it looks as though perhaps they might be at the end of this cycle, at least for now.
Well, that's right. So one of the more interesting things here, of course, for the dollar is while stocks had their very robust rebound from those lows in April, the dollar has not. It's continued to move lower, and we have it against the euro here because, of course, we did just have the ECB have a policy announcement where they cut rates. But, of course, this is also the most liquid counterpart for the dollar. So it's a good barometer on what the overall direction is. And we can see it's starting to make way toward this key high that was set in early April. Against the backdrop of all of that Liberation Day turmoil, right above the 116 figure. The ECB, for their part, coming out and saying, look, we understand that the tariffs might be a risk to growth, but also all of this defense spending that the EU wants to do next year is probably a boon for growth and an uplift on inflation. So we might be getting to the end of our rate cut cycle, and indeed the forecasts they released that they update every quarter were not exactly flashing red around tariff risk. There was a lot of concern about maybe they're going to become much more negative. They weren't included, those tariffs, in the March update. This update basically unchanged. So the ECB clearly balancing domestic spending against that risk, and that's been helpful for the euro. I think people make a little bit too much of this loss of U.S. exceptionalism because, of course, there is no alternative. And so the dollar is going to continue to be as dominant as it has been for the most part, as are treasury bonds as the go-to risk-free asset for the markets. But that doesn't mean that you can't have moves within those extremes. It's not as though the dollar is the only game in town and it can't go down. It can. We have an ECB that looks to be almost done cutting rates, certainly after this year, and the Fed that we are increasingly expecting is going to have building rate cuts for next year, as we've just discussed. So that's a very straightforward yield differential story, and the dollar is not going to be looking very good if it plays out as seems to be gaining steam.
Ilya, always true to get across the charts. Thanks so much for joining us in Tasty Live.
Thanks very much, Andrew.
And that is the trade for this Friday.
The Trade was brought to you by Vantage Markets, delivering one of Australia's most trusted and award-winning trading experiences. Explore smart trading at vantagemarkets.com.au.